All right, a very warm welcome to you. This is yet another episode of Market Pulse with me, Jimmy Mbogo. And of course, today we're looking at StanChart's performance, just looking at the full year 2024 and the outcome that is. So, and of course, just to go through the numbers, we're talking about a profit before tax that went up about 43%. Profit after tax went up about 45%, that is to 20.1 billion from 13.8 billion. And also just looking at top line growth about 21%. And to help me analyze some of these numbers, I'm here with the CEO, that is Kariuki Ngare. So Kariuki, thank you so much for making time to speak to us.
Thank you.
All right, so just looking at 2024, in a nutshell, how was that year for the bank?
As the numbers have said, it was a fantastic year for the bank. We had a record performance, and we are very pleased with our outcome. And this performance was driven by a top line growth of 21%, that record income of 50.7 billion. Then very well controlled costs, growth of 8%, giving us positive jaws of 13%, hence giving the profit before tax up 43% to 28.2. So it's a very pleasing outcome and very well balanced in terms of the key segments, both segments, the CIB business, that's like our corporate and investment banking, and then our wealth and retail banking, WRB, did very well. Both segments.
So and just looking at those numbers again, we see that the CIB continues to outperform the WRB. And I just want to know, what is it that you're doing when it comes to corporate banking, corporate and investment banking, that maybe the retail side is lagging behind?
We don't look at it as lagging behind. It's just the nature of that business, where you find that in our CIB business, it tends to be big corporates, big deals. So, and then in terms of that, so it basically means the revenues tend to be a lot larger in that. And then if you look at profit before tax for our CIB business, the cost base is much lower, because obviously when you look at the headcount in the CIB business, it's much smaller. But still, WRB is firing as well. Very strong growth, very strong performance for 2024 as well. So we've got two very balanced businesses that are both firing on both cylinders extremely well.
All right, so just looking at the CIB business for 2024, what are some of the big deals that you can think of top of mind?
I think we look at some of the deals that we did in the market, organizing one of the for one of the leading telcos, a sustainability-linked loan that is unique in this market. That has worked very, very well. Then supporting other companies in this market, whether it's on their working capital requirements or it's their expansion requirements, those continue working very well. And also in the space of whether it's on FX, whether it's hedging the shilling against the dollar or any other currency, those are some of the deals that immediately come to mind that we did very successfully in our CIB space.
And what was the value of that sustainability loan?
The loan was 15 billion, if you recall. It was 15 billion. That's the loan we managed to organize.
Yes. All right. So the other thing that I've seen from the results, when you look at customer deposits, this went down by about 14%. Could you tell us what led to that? And also, what are some of the measures that you're putting in place to attract deposits going forward?
There are two ways you look at that, and the main driver of that is obviously the FX, because obviously when you report, you're reporting in local currency. So when the shilling strengthened, then that, if you look at the shilling, when we reported the prior year, 2023, it was about 160. By the time we are reporting this year, it has turned to about 120, 128, 129. So that obviously reflects into a big drop in the foreign currency deposits. That is one of the biggest contributors. On the other hand, we also get a lot of money moving into our assets under management, into our wealth management. So overall, we are not unduly worried that, because we know where the deposits are going. We are providing alternatives for our clients. Before, it was always any client who came to us that wanted a better interest rate, or wanted a better rate for their fixed deposit, but now we've got other solutions. So when you look at the growth in assets under management of 27% to 235 billion shillings, that tells you where some of those deposits are going. So we are pleased with the outcome, and we are not ideally worried. All right,
so another significant drop that I've seen from these results is your loan book portfolio, particularly the foreign currency loan. This went down by about 28%. Correct. And what does this then reflect? Is it a reduced appetite in the global market, or what was the thinking behind this, and how did we arrive at this number?
Again, it's driven by the market. If you look at last year, credit growth has been very subdued. What that informs you is that the opportunities are fewer. So 2024 was a challenging year. And that is what drives that. We do not create new assets. We create assets in response to clients. If clients want to expand their businesses, if clients either whether it's capital outlay or working capital, that's where we come in. And 2024 was a very subdued year as credit was concerned. Yeah. And that is a primary driver of that. And we've also started seeing clients, because of the risks that they faced earlier in the year in terms of foreign currency availability and the depreciation of the shilling, them switching the assets from FC, foreign currency denominated asset, to local currency denominated asset. That is also a driver of that as well, where people now say, no, let me just borrow in shillings. It's more stable, it's more predictable for me. That's where I want to move. That's the space I want to be. Because prior years, because of the stability that was always there, and it was cheaper to borrow in dollars. But when you start looking at the depreciation of the currency, the reality has come in terms of the foreign currency risk.
Yeah. Also, in just looking at your entire loan portfolio, how much does foreign currency denominated loans account for?
It's about, I would say, 40% of our total book. Our book tends to be a lot more denominated on the local currency.
Yeah.
Yes.
All right. So let's come back to the Kenyan market, and of course we've seen a lot of concerns, particularly with risk-based pricing. We've even seen the CBK sort of become a bit heavy-handed when it comes to sort of forcing banks to issue credit to the market. Now there are those who believe that had banks not started lending to the economy, in another 6 or 7 months, we'll be heading to a recession. What are your thoughts?
It's not. I think it's mistaken. Banks lend in response to demand for credit. Their demand has to be there. In the first place, somebody has to come up and say, I want to do this business. I want to expand my business. I want to build a new business. Then they approach the banks, and the banks respond to that. So, and that's our business. We are in the business of lending. We are in the business of taking risks. Yeah. So if the market is subdued as it was, the credit was subdued there it was last year, then there's something that needs to happen in the wider economy for the banks to come in and to help, to come in and lend and respond to the demand. That really is a driver. It's not the banks can't lend in a vacuum. You respond to a need that is already there. So if the need isn't there, then you cannot be able to participate in that economy. And I believe with the right policies that have been put into place, where we are going to single-digit inflation, a stable exchange rate, and declining cost of credit, that spur will happen. And you'll start seeing banks going back because the demand will come. All right. Clients will be more comfortable to say, I can borrow at this rate. I can afford to borrow at this price. I can afford to borrow because everything now is stable. I can be able to go to the banks and approach it. That is the approach I believe that is going to happen in 2025. All
right. Are you concerned about NPLs? Because what we have seen from your set of results is a slightly higher or an increased level of impairments for provision for that.
No. It's the opposite. If we look at the industry, looking at the last results that are publicly available, is the industry was about 16.4. Yeah. That's high. That's high. It tells you that there's strain in the economy. That there's strain, and obviously we need to work together to see how that number can be brought down significantly. Yeah. If you look at our number at 7.4, we are very comfortable with that number. It shows that the quality of our loan book is very good, and we continue working to ensure that it remains so. So yes, we would like the industry NPLs to be lower digits, because that shows that the overall economy the cost of credit is going to be lower. So as a bank, we are not concerned from our perspective in terms of the numbers that we are registering, but from an industry perspective, yes, it's a cause for concern.
All right, so are you concerned that if anything was to happen maybe to the CIB segment, then the bank's performance would be adversely affected?
I would say both, either of the segments. I would not say either of the contribution from both segments is important. So we ensure that both segments are performing as expected, because both of them, if you look at it, it's a very well balanced business. And with that very well balanced business, if one does not perform, it might be pretty difficult for the other to really lift up. Yeah. But we see that balanced business is important for us. So I'm confident that they'll continue to perform strongly.
All right, there's a specific demographic that I want you to speak to. Now, from the results we're talking about, 27% growth in wealth management, and I just want to know, for young people, how then do they tap into this? What are some of the options for them? Because again, when you look at their disposable income, it's not the same as someone who's been an investor over the years.
Yeah, I think It is the products that we have in wealth is available for the young people as well. SC Shilingi, for instance, SC Shilingi you can invest as low as 1,000. So, and it is registered one of the 151% growth year on year from between 2023 and 2024 to 17.2 billion. And that is appealing to a lot of the younger demographics. And we are very happy about that. And what makes it even more appealing for them and for us as well, it's fully digital. Everything is done digitally. So we've created products that suit the younger demographics, middle-income demographic, middle-aged demographics, or even older demographics.
Yeah.
Even the other one that is our mutual funds as well. It's not. It does not necessarily. Sometimes that number may sound that you only require people with a big amount of income. No, from $1,000, that's 100,000. You can be able to invest. There are people who invest on some of what you call the monthly investment. They make an investment of $100 or $200. So it caters to everyone's income level.
Yeah.
What is most important and what distinguishes is the risk appetite. How much risk do you want to take so that we can give you the product that suits your risk appetite.
All right, so let's talk about the liquidity of the bank. And
Yes.
of course, knowing StanChart, it's one of the properly funded banks. And I want to know, when you look at the requirement that now, the core capital requirement, moving now to about 10 billion shillings, is StanChart considering maybe a merger or an acquisition going forward?
No, I think we don't need that. I think in terms of, you look at our capital in excess of 60 billion, I believe, what we have today, we've got enough capital to do what we need to do in this market. And we don't just do mergers for the sake of it. It's a question of what are you trying to acquire, what are you trying to bring on board. We believe that with our two businesses, whether it's in the CIB, WRB, we've got the capital and the know-how to be able to tap into the opportunities that exist in this market. So we are very, very comfortable with that, and we are not looking to merge or to buy or to acquire any of the other banks.
All right, so let's talk about your retail customers. And of course, we know that you're big on the investment side, but for retail customers, what can they expect going forward into 2025?
They should expect more diversified products, especially on our wealth space. We will expect them to get, what can we get more products on the platform?
Yeah.
We've seen an interest. For instance, one of the fastest growing products is what we call the ESG, environmentally and socially acceptable products that are linked to sustainability. We expect to keep on putting more of those on the platform so that people can decide, I only want to invest in this fund because it ties into my personal beliefs or principles.
Yeah.
We expect to see that. So a diversified range of options that you want to buy. They would like to get the platform to be a lot more responsive. That's what they would sometimes they tell us in terms of the response rate, availability rate. Those are some of the things that we want to work on them for them to be able to access. So more diversified range of products, easier to work with, and most important for our availability of our relationship managers, so that in case you need advice, maybe there are some products that you find a lot more complex and you need to speak to someone, there'll be a human voice to guide you through the process.
All right, so again, just looking at the outlook for 2025, what's keeping you up at night?
I think 2025 is going to be an interesting year.
Yeah.
Definitely, at the local scene, I would call it a normalizing year. We've seen stable exchange rate, inflation in single digits, lowering of the cost of credit. So we expect things to normalize, which is very, very good for the economy.
Yeah.
Globally, 2.0, we can't escape from that. I think the disruptions that have happened within a month, it's not even 2 months, it's about a month that is
About a month
easy
and
as-
a half,
yeah,
yeah.
it's about a month and a half, and you can see what has happened. That probably could lead to new supply routes, new disruptions, and it could also affect Kenya as well. We've seen the impact of US aid when we look at the number of employees who are already employed there. Think about the effects. All those employees, they had houses, they had loans with banks, they had people in school, children. We've looked at the funding to our healthcare sector. That's going to cause some disruption. There's going to be some disruption, definitely.
Yeah.
So that disruption could cause a bit of turmoil at the beginning, but it's a question of how well we position ourselves to take advantage of the new world that is emerging. How well does Kenya position itself to take advantage of that new world?
Yeah.
Because there'll be new manufacturing hubs, there'll be new supply routes, people will be looking for new markets, new trade partners. How well do we position ourselves to be able to play in that new economy that is clearly going to come out of that?
All right,
So I don't lose sleep over it. If anything, I just want to see what is the latest tweet and what does it mean. So it's a question of what are the new opportunities and are we ready to take advantage of those new opportunities.
All right, so when we were here with you sometime last year, one of the things that you told me then is that you're looking to divest from government securities. And I just want to know, what are the new avenues of investment that you're looking at? And also, are you likely to go back into heavy investment in government paper?
We've always been, we're still in the government paper. That is always an option.
Yeah.
But our first option is always client asset.
Mm-hmm.
And if the client are coming to us for assets, for loans and facilities, that will always be our first opportunity.
Yeah.
We go to government paper when the option is not there. And for most of last year, as I said, credit is pretty subdued.
Yeah.
So you've seen, if you look at compared to 2023, in terms of our government exposure, that has gone up. So that's where we put our spare cash, our spare deposits or investments.
Yeah.
And that's the same thing that we'll continue doing this year. Our first priority will always be clients. When they come to us, that will always be the first priority.
Mm-hmm.
Then if there's any extra money on the table, that's when we'll start going to government bonds or government investments.
All right, so key sectors that you're looking to invest in this year besides government paper?
If you look at the telcos, is important.
Yeah.
Manufacturing is important. If you look at agribusiness as well, that's an important sector as well,
Yeah.
especially the ones where they're exporting in the export business, whether it's flowers, horticulture, floriculture, that's important.
Mm-hmm.
So those are the sectors that we look at, and we see that, and then and trade as well.
Mm-hmm.
Sectors are involved in the trade business, whether it's on trade services, that's another area that we focus on as well.
All right, maybe can you tell us in terms of your projected exposure, particularly in trade, because these are good ones.
I don't have the specific numbers in terms of what is our exposure going to be, but those are the areas that we look at to focus on.
All right, and of course, we'll be looking forward to those sets of results, maybe by end of Q1, Q2, half year, or even full year, see where the bank is.
Thank you.
All right,
looking forward. Very optimistic about 2025 as well.
All right, thanks so much for making time to speak to us here on Market Pulse. And of course, that's all we have time for on this episode of Market Pulse. Make sure to catch the next episode next week on Wednesday, same time, same.